Welcome to the deep dive. In our hyper-connected world, speed, security, scalability, they're not just nice to haves anymore, are they?
No, definitely not. They're pretty much the baseline expectation for, well, everything we do online.
Exactly. Every click, every stream, every purchase depends on this huge invisible infrastructure humming away. And today, we're going to pull back the curtain a bit on a company right at the heart of that, operating at what they call the edge of the internet, FSLY Inc.
Right. One of those key players making things fast and secure, often without us even realizing it.
Quietly enabling everything.
And for this deep dive, you, our listener, have given us this really comprehensive investment analysis of FSLY, ticker FSLY. It covers, well, pretty much everything.
Yeah, the business model, financials, the challenges, and there have been some challenges, and where they're headed.
Exactly. So our mission here is to kind of sift through all that material, pull out the most important nuggets, the key insight. We want to help you get a really clear picture of FSLY's strategy, the opportunities they see, and also, crucially, the risks they're facing. It's a very, very dynamic market out there.
No kidding. So let's dive in. Prepare for an exploration of that unseen infrastructure that powers so much of your daily life. Might find some surprising stuff, but definitely aiming for clear takeaways.
Unpacking FSLY's edge, more than just a CDN.
Okay, let's unpack this. FSLY calls itself an edge cloud platform. Now, a lot of people hear edge and immediately think CDN, right? Content delivery network, speeding up websites.
That's the traditional view, yeah. Caching stuff closer to you so it loads faster.
But FSLY insists it's more than that. So what does an edge cloud platform actually mean in their book? And why is that distinction so important for them?
It's absolutely vital because it speaks to their ambition. So at its core, their platform is about processing, serving, and securing applications literally as close to the end user as possible at the internet's edge. Think about the scale here. We're talking hundreds of billions of internet requests daily. It's this global foundational infrastructure.
Wow.
But the key part, the beyond CDN part, is that it's also programmable. It's not just about delivering static files faster.
Right. So programmable. What does that unlock? What can it do that a simple CDN can't? And why is moving beyond just caching so critical for them? Seems like a crowded market.
It is, and that's exactly why it's critical. The traditional CDN market, just caching images and videos, it's facing, well, increasing commoditization. It becomes a race to the bottom on price.
The lowest bidder wins.
Exactly. FSLY's focus on a programmable edge means they're not just storing stuff. They're actually running application logic customer code right there at the edge.
Okay, give me an example. What does that look like?
Okay, imagine an e-commerce site. You want real-time personalization based on where I am or what I just looked at. Or maybe a complex API request needs some custom authentication or data fiddling before it even hits the main server. Traditionally, that request has to travel all the way back to a central data center, latency city.
Yeah, slow.
With FSLY's programmable edge, that logic can run just milliseconds away from the user. Huge reduction in latency, takes load off the central servers, and allows for much richer, more dynamic, secure experiences.
Okay, so the edge isn't just a cache. It's like a mini computer network out there.
That's a great way to put it. A distributed computing environment, yeah.
That makes a lot more sense. So given this sophisticated platform, how do they actually make money? What are the main revenue streams, and how do their products reflect that strategic shift you mentioned?
Right, so their revenue is mostly usage-based, and they break it down into three main segments. And these segments really tell the story of their evolution. The biggest chunk is still network services. This is the foundational stuff: core content delivery, performance, speeding up websites, APIs, media. In Q2 2025, that was about $114.9 million, growing steadily, about 10% year over year. It's the workhorse.
The bread and butter?
Exactly. Then you've got security. This has become a really significant growth engine for them. We're talking their next-gen WAF, web application, firewall, DDoS protection, bot management, that whole suite.
Okay.
That segment brought in $29.3 million in Q2 25, growing faster at 15% year over year. And what's really interesting is that security now makes up 20% of their total revenue.
20%, that's substantial.
It really is. It shows they're successfully cross-selling these services into their existing delivery customers, and there's clearly strong demand for security right at the edge.
Makes sense. And the third segment?
The third one is labeled Other. It's the smallest right now, only about $4.5 million in Q2, but strategically, it's arguably the most important for their future.
Why is that? What's in other?
This is primarily driven by Compute at Edge, their serverless edge computing product, and also their observability tools. And here's the kicker. It's growing at an accelerated rate of 60% year over year.
60%. Okay, that's hyper-growth territory.
Absolutely. Off a small base, sure, but that divergence in growth rates tells you everything about their strategy. Network services, stable but moderating. Security, growing nicely. Other, mainly compute, exploding.
So compute at edge is the future, essentially.
It's definitely where they're pinning their hopes for differentiation, customer stickiness, and, hopefully better margins down the line. It's the clearest sign they're moving up that value chain from just delivering bits to being part of the application itself.
Got it. So with this platform, who are they targeting? Who are the ideal Fastly customers, and what are they actually using it for?
They really zero in on developers and enterprises where digital performance isn't just important, it's absolutely mission critical. Think about it, companies that live and die by their online presence. Well, you see big names across different sectors.
Yeah.
In digital publishing and media, like Gannett, USA Today Network, e-commerce and ticketing, Ticketmaster is a big one.
Oh, yeah.
High-tech, SaaS companies like New Relic, GitHub, social media like Pinterest. These are all businesses where even tiny delays or downtime can mean lost revenue or lost users.
That's a solid list. Now, you mentioned earlier their developer-centric or bottoms-up approach. Can you unpack that a bit? How did that differ from, say, a more traditional competitor?
Yeah, this is quite distinct. Fastly really focuses on empowering the developers themselves. They provide powerful, flexible tools, great APIs, lots of documentation.
Made it easy for the techies.
Exactly. So instead of a big top-down sale to the CIO, that might take months or years.
Right.
A developer or a small team can start using Fastly for a specific project, maybe using a free tier or a small plan. They see the benefits, they show it works, and then that success often bubbles up within the organization, leading to wider, maybe even enterprise-wide adoption.
The classic land and expand.
Precisely. It's very different from the old school approach of someone like, say, Akamai, who traditionally sold big prepackaged solutions directly to the C-suite. Fastly cultivates loyalty right from the engineers building the stuff.
Which can be powerful.
Very. And they're increasingly focusing their efforts on those larger enterprise customers, the ones spending over $100K a year, because that's where that land and expand motion really pays off.
Okay. So if Fastly sees itself as this pure play, best-of-breed edge specialist, built from the edge inward, that sounds like they're squaring up against the big cloud providers, right? AWS, Azure, Google Cloud all have edge offerings. What makes Fastly different?
It really comes down to their fundamental philosophy and architecture. The hyperscalers, AWS, Azure, Google, they tend to view the edge mostly as an extension of their massive centralized cloud.
Like an outpost.
Sort of, yeah. Primarily for caching or running very basic functions to offload traffic from their main data centers. Fastly's approach, especially with compute at edge, is different. It's built on WebAssembly, WASM.
WASM, okay. What's the significance of that?
Well, WASM is an open standard. It's high-performance, secure, and supports multiple languages developers already use, like Rust and JavaScript. It lets them run complex customer code efficiently right at the edge, not just simple caching rules.
So it's more deeply integrated.
Much more. The value proposition is, if you have workloads that absolutely need the lowest possible latency, the highest degree of control, and you need custom logic running instantly near your users, a specialized platform like Fastly is designed specifically for that. It might offer superior performance compared to a more general-purpose edge service bolted onto a big cloud.
But that creates stickiness.
Huge stickiness. When customers build their core application logic onto compute at edge, Fastly becomes deeply embedded. Switching costs go way up. They're not just a vendor you can easily swap out. They become a critical part of your infrastructure. It's purpose-built versus a general add-on.
The evolving landscape CDN to edge computing.
Okay, let's zoom out a bit and look at the bigger picture. The market Fastly operates in. You mentioned it's a kind of a tale of two markets, right? CDN and edge computing. How big are these, and what's the growth trajectory look like?
Yeah, exactly. Two converging markets, but with very different dynamics. First, you have the global CDN market. It's definitely substantial. Estimates for 2024 put it somewhere between, say, $23.7 billion and $25.6 billion.
That's pretty big.
It is, but it's also maturing. Growth is still there, driven by video streaming, mobile, gaming, e-commerce, all the usual suspects. But the growth forecasts, the CGRs, they vary quite a bit. Some see it around 11%, others maybe up to 23% through the early 2030s. Solid, but maybe not explosive.
Okay. And the other market, edge computing.
That's where things get really interesting. The edge computing market is significantly larger and way more dynamic. Estimates for 2025 are much higher. I think $168 billion to maybe $228 billion.
Okay. Massive difference.
Huge.
Yeah.
And the projected growth rates, the CVGRs, are also generally higher, often pegged somewhere between 8% on the low end to maybe 28% on the high end through 2034.
What's fueling that kind of growth?
It's things like the explosion of IoT devices, the rollout of 5G making new real-time applications possible, the increasing need to process vast amounts of data locally, AI inference happening at the edge. It's a much broader and, frankly, more exciting space.
Right. And that difference in size and growth really hammers home FSLY's strategy, doesn't it?
Absolutely. It highlights their strategic imperative. They have to transition successfully from being seen primarily as a CDN provider to being a leader in this broader, faster-growing, and potentially much more lucrative edge computing arena.
And it's interesting you mentioned the wide range in those edge market estimates. It kind of points to how new and undefined it still is, right?
Sure.
Huge opportunity, but also a lot of uncertainty.
Exactly. It's still emerging, still taking shape, which means opportunity, but also risk. FSLY's long-term success really hinges on navigating that transition effectively.
Okay, so they're trying to make this big shift, but who are they up against? Describe the competitive landscape. It sounds pretty intense.
Oh, it's incredibly complex and fiercely competitive. You can really break down their rivals into about 4 distinct categories.
All right, lay them out for us.
First, you've got the legacy CDN leader, Akamai. They've been around forever, have the largest global network, deep relationships with huge enterprise customers, and very strong security offerings. Their strength is scale, reliability, and that established trust.
The incumbent.
Definitely. Second, their most direct competitor is probably Cloudflare. They're a major direct edge competitor. Cloudflare offers a very broad, integrated platform delivery, security, compute, all bundled together. They have that massive free user base, which is a huge funnel, and they really emphasize ease of use.
Right, often seen as the main rival.
Very much so.
Sure.
Third, and perhaps the biggest long-term threat, are the hyperscale cloud providers.
Yes.
AWS with CloudFront and Lambda at Edge, Microsoft Azure, Google Cloud. The giants. Their power comes from bundling. They can easily package basic CDN and edge functions with their enormous cloud ecosystems. For existing cloud customers, it's often just easier and cheaper to add edge services from their main provider.
Convenience and bundled pricing. Big advantages.
Huge advantages.
Yeah.
And finally, you have a scattering of specialist and niche players. Smaller companies like StackPath, Edgio, maybe others focusing on specific industries or use cases.
Wow, okay. That is a crowded and powerful field. Akamai, Cloudflare, AWS, Azure, Google. So what does this all mean for FSLY? What's their central challenge in this fight? Is it just about being cheaper?
Definitely not about being cheaper. They can't win a price war against the hyperscalers. Their central strategic challenge is to prove consistently that their best-of-breed approach focusing on superior performance, deeper programmability, that great developer experience provides enough unique value.
Enough value to make customers choose them over the convenience or bundled pricing of the bigger players.
Exactly. They have to demonstrate a clear ROI, a tangible benefit that makes choosing their specialized platform worthwhile. Their competitive moat isn't just about having lots of servers. It's built on the quality of their architecture and that deep focus on programmability.
Okay, so what are those key differentiators? What makes up their moat?
Several things. That developer-centric approach we talked about is huge. Robust APIs, configuration as code using VCL or Terraform, seamless integration into CI/CD pipelines. Developers tend to really like working with FSLY.
Building loyalty from the ground up.
Right. Then there's the real-time programmability, especially compute at edge running Weziman. That ability to execute complex code instantly at the edge is a major technical advantage for certain applications.
Like the e-commerce example.
Exactly. And they're also known for superior performance and instant purge. That patented instant purge capability is a big deal.
Remind us what that does again.
It lets them invalidate cached content globally in like 150 milliseconds on average. So if news breaks or a price changes, that change is reflected everywhere almost instantly.
Which means you can cache things you otherwise couldn't.
Precisely. Highly dynamic content becomes cacheable, which dramatically improves performance and reduces load on the customer's origin servers. It's a significant technical feat.
Okay. Anything else?
Yeah. Their efficient network architecture. They actually use fewer but more powerful and strategically placed points of presence, or POPs, compared to some competitors.
Fewer POPs, how is that better?
It sounds counterintuitive, but the idea is that by concentrating traffic into these powerful hubs, you increase the chances that requested content is already in the cache at that POP, a higher cache hit ratio. This means fewer requests need to go all the way back to the origin, improving performance and efficiency.
Interesting. Fewer but smarter POPs.
Kind of, yeah. It's about cache efficiency.
Got it. So despite these strengths, what are the barriers to entry for someone else trying to do this? And what are the biggest threats to Fastly?
Well, the main barrier to entry is just the sheer cost and complexity. Building a truly global high-performance network like Fastly's requires enormous capital investment and deep technical expertise. It's not a startup game anymore, really.
So the real threat isn't new entrants, it's the existing players.
Exactly. The biggest threat comes from those established tech titans we mentioned, especially the hyperscalers.
Because they can subsidize their edge offerings, use aggressive pricing.
Precisely. They can bundle edge services with their core cloud offerings, potentially even offer them below cost initially just to win market share or keep customers locked into their ecosystem. This creates a constant risk that basic edge functions could just become a commoditized feature.
Squeezing margins for specialists like Fastly.
Right. And that commoditization pressure, especially in core content delivery, is like a double-edged sword for Fastly. On one hand, yeah, it puts constant downward pressure on pricing and gross margins for their bread-and-butter network services segment. They can't win a price war there.
But the other edge of the sword.
The other edge is that this very pressure has basically forced them to innovate and move up the stack. It's pushed them hard into developing and selling those higher-value, stickier services like security and compute at edge.
Ah, so the pressure is a catalyst for change.
Absolutely. That impressive growth we're seeing in security, 15% UI, and compute, 60% UI, isn't just nice. It's essential. It's proof that this forced evolution, driven by market dynamics, is happening and is critical for their long-term competitive health and financial future. It's a necessary pivot.
Fastly's financial journey, from headwinds to headway.
Okay, let's pivot ourselves now and talk about the financials. This is where we see the rubber meet the road, right?
Yeah.
How has Fastly's revenue actually performed over the last few years? You mentioned it's been a bit of a ride.
It definitely has. If you look at their revenue growth trajectory, there was a clear deceleration after the boom times. They had that huge 45% year-over-year growth back in 2020.
Wow.
Yeah, but then it slowed down quite a bit. It was around 22% growth in 21 and 22, then dipped to about 17% in 23, and only 7.5% in 2024.
Ouch. What caused that slowdown?
It was a mix of things. Partly the law of large numbers. It's harder to maintain super high growth as you get bigger. Plus, intensifying competition, those macroeconomic headwinds we discussed impacting customer usage.
Right, budget tightening.
Yeah, and very specifically, the significant drop-off in traffic from their former top customer, TikTok, that had a noticeable impact.
But you mentioned things might be turning around in 2025. What did the latest numbers show?
Yeah, the recent reports are definitely more encouraging. We saw revenue growth start to pick back up. Q1 2025 showed 8% year-over-year growth.
Got better?
And then Q2 was even stronger, showing 12.3% year-over-year growth, hitting a record $148.7 million for the quarter.
12.3%. That's a noticeable reacceleration.
It is. And significantly, management actually raised their full-year guidance for 2025, suggesting they expect around 9% to 10% growth for the full year.
So the ship might be turning.
It looks like it. This reacceleration, if they can sustain it, is really a cornerstone of the current investment thesis for Fastly. It suggests their strategic moves, especially pushing into security and compute, are starting to pay off on the top line.
Okay, top-line growth is one thing, but what about customer metrics underneath? What do they tell us about the health of the business and that strategic focus?
Yeah, digging into the customer metrics gives really crucial context, and it clearly shows that strategic shift in action. Let's look at customer count first. There's an interesting divergence happening.
How so?
Their enterprise customers, the ones spending over $100,000 a year, that number grew modestly. It reached 622 in Q2 2025, which was up 21 from the year before.
Okay, growing the big accounts.
Right. But their total customer count actually declined year over year from about 3,295 down to 3,097.
Fewer total customers. Is that bad?
Not necessarily. It likely reflects that deliberate strategy we talked about, focusing their sales and support efforts on those larger, more strategic, potentially more profitable enterprise accounts, and maybe letting some smaller, less strategic customers churn off. Quality over quantity, perhaps.
Makes sense. What about customer retention? That's always key for platform businesses.
Absolutely critical. And here, the net retention rate, or NRR, tells an important story. Fastly's last 12-month NRR had been a point of concern. It actually dipped down to 100% in Q1 2025.
Which means they weren't growing revenue from existing customers, basically just replacing churn.
Exactly, which is not what you want to see in a platform business. But crucially, it recovered to 104% in Q2 2025.
Okay, 104%. Better.
Definitely better. You really want to see NRR comfortably above 100%. It shows the platform is sticky, customers are finding value, and they're expanding their usage over time. That recovery to 104% is a positive sign they need to build on.
And customer concentration. Given the TikTok experience, have they managed to diversify?
Yes, they've made real, tangible progress here. Revenue from their top 10 customers fell to 31% of total revenue in Q2 2025. That's down from 34% the previous year.
Okay. Still significant, but moving in the right direction.
Right. And maybe even more importantly, the revenue from customers outside that top 10 grew by a strong 17% year over year.
So the broader base is growing much faster than the very top accounts.
Exactly. That 17% growth significantly outpaced the mere 2% growth from the top 10. It indicates a much healthier, more diversified growth engine is developing, which is exactly what you want to see after that TikTok lesson. Less reliance on any single giant customer.
Okay, so revenue is reaccelerating, customer base is shifting towards enterprise, NRR is recovering, concentration is reducing. But are they actually making money? What's the path to profitability look like?
That's the million-dollar question, or maybe the billion-dollar question, given their history. Historically, Fastly has posted significant losses on a GAAP basis, generally accepted accounting principles.
Right, the official numbers often look rough.
Yeah, they had a negative GAAP operating margin of nearly 31% in fiscal 2024. That reflects heavy spending on R&D, building out their network, and also significant stock-based compensation costs.
But are things improving on a non-GAAP basis? That often gives a better sense of the underlying operational health.
Yes, and that's where the positive story is emerging. Their non-GAAP operating loss has narrowed quite dramatically. In Q2 2025, it was down to just $4.6 million.
Okay. How does that compare?
That's a 60% improvement compared to the loss in Q2 of the prior year.
60% improvement. How'd they manage that?
It comes down to operating leverage. Basically, their revenue grew faster, 12% YoY in Q2, than their operating expenses, which only grew 2% YoY. Costs are being managed more tightly as revenue recovers.
So discipline is kicking in.
It appears so. And the big news is that management now expects to achieve non-GAAP operating profitability in the second half of 2025.
Profitability. That would be a major milestone.
Absolutely crucial. Hitting that mark would be a huge signal to the market that their turnaround plan is working and that the business model can be financially sustainable.
Okay, profitability is one thing.
Yeah.
What about actual cash? Are they generating cash or still burning through it? That's often what investors focus on most keenly.
And this is probably the most significant financial development for Fastly recently. They've turned positive on free cash flow, or FCF.
Really? After years of burning cash?
Yes. After years of negative SCF needed to fund their growth, they generated positive FCF of $8.2 million in Q1 2025, and then an even stronger $10.9 million in Q2 2025.
Wow. Compare that to performance.
It's a dramatic reversal. In Q2 of 2024, they had negative FCF of $18.5 million. So swinging from negative $18.5 million to positive $10.9 million in a year. That's huge.
Yeah, it really is a massive turnaround. Yeah. What does that signify for the company and for investors looking at it?
It signifies that the business is now demonstrating an ability to fund its own operations and growth initiatives internally. It dramatically reduces their financial risk, makes them less reliant on raising external capital, whether debt or equity.
Which is always expensive or dilutive.
Exactly. Management's guidance for positive FCF for the full year 2025 signals a fundamental shift. It suggests a new era of capital discipline, operational efficiency, and ultimately, financial self-sufficiency is arriving for Fastly. It makes the investment case much less speculative.
Lessons from the Crucible challenges and strategic reset.
All right, so we've seen the progress, the turn towards profitability and positive cash flow. But no company gets there without hitting some bumps, right? Especially in tech. What were some of Fastly's biggest hurdles recently? How did they shape the company we see today?
Oh, absolutely. They've definitely been through the ringer. The most famous, probably the most impactful challenge was the whole situation with ByteDance, the parent company of TikTok.
Right, you mentioned that earlier. What exactly happened there?
Back in October 2020, Fastly had to suddenly revise its Q3 guidance downwards. The reason? TikTok's usage on their platform didn't meet expectations, and they cited the uncertain geopolitical environment. This was during the Trump administration's pressure on TikTok.
And TikTok was a huge customer back then.
Huge. At the time, TikTok accounted for something like 12% of Fastly's total revenue.
12% from one customer. Wow. That's massive concentration risk.
Textbook definition of it. The impact was immediate and severe, both on their financials and, importantly, on investor confidence.
So what was the lasting lesson from that? How did it change things?
It was a really stark, painful lesson in the dangers of customer concentration, especially with a usage-based model where revenue from one client can just evaporate quickly due to external factors.
Like geopolitics.
Exactly. Now, Fastly says U.S. TikTok traffic is less than 2% of revenue, but management is still being super cautious. They actually exclude all potential revenue from TikTok's U.S. traffic in their 2025 guidance, just as a precaution against any future legislative action.
Better safe than sorry, I guess.
You could say that. The whole episode definitely left a scar and created a lasting impact on how investors viewed the company's risk profile. It absolutely forced them to prioritize diversifying their customer base, which, as we saw, they've made progress on. It was a real wake-up call.
Okay, so TikTok was a big one. What other headwinds did they face?
Well, layered on top of that, through much of 2023 and into 2024, they were hit by the broader, challenging macroeconomic environment.
Like everyone else, pretty much.
Yeah, management talked quite openly about demand headwinds and seeing budget tightening from their large customers, especially in sectors like media and entertainment, which are big for them.
So as their customers felt the pinch,
They pulled back on spending, maybe optimized their traffic, delayed projects, and since Fastly's revenue is usage-based, that directly translated into slower growth for Fastly.
so that inherent sensitivity to customer business cycles is just part of their model.
It really is. When enterprise IT budgets tighten, Fastly feels it pretty directly. That cyclical exposure is definitely a key risk factor and played a big role in that growth deceleration we saw.
And then there's the competition we talked about earlier. That pressure didn't let up, I assume?
Not at all. It only intensified. They're fighting that multi-front war against the hyperscalers, against Cloudflare, against Akamai, all very well-capitalized, aggressive competitors.
Right. And you mentioned management was pretty candid, admitting that even though their security revenue was growing, it wasn't really growing faster than the overall market, and some big competitors were growing even faster still. What does that tell you?
It tells you just how hard it is to gain significant market share in these critical growth areas, even if you have good tech. It suggests they were struggling, at least for a time, to really break through and capture a dominant position in security against established giants who could maybe bundle more aggressively or spend more on sales and marketing.
So good growth wasn't necessarily great growth relative to the competition.
Exactly. And meanwhile, that core content delivery market kept maturing, leading to more commoditization of basic bandwidth.
Putting pressure on prices and margins.
Sustained downward pressure. We saw their GAAP gross margin compress, right? From almost 59% in 2020 down to about 54% by 2024.
Which just highlights again why that pivot to security and compute was so urgent. They couldn't just keep fighting on price for basic delivery.
Absolutely not. So when you put it all together, the TikTok shock, the macro slowdown, the intense competition, the commoditization pressure, it really was a trial by fire for Fastly.
Sounds like it.
But, sometimes those trials forge stronger steel. These challenges collectively forced what seems to be a necessary and maybe ultimately healthy strategic reset.
How so?
Well, the TikTok issue mandated diversification. The slowdown forced operational rigor and a focus on profitability. The competition demanded innovation in higher value areas. And these pressures were almost certainly a major catalyst for the leadership changes we saw, bringing in a new CEO and CFO in mid-2025 with that dual mandate of growth and profitability.
So the Fastly we see now, the one focused on profitable growth, diversification, positive cash flow, it was essentially forged in the crucible of those challenges.
I think that's a fair way to characterize it. The strategy they have now seems like a direct response to the harsh lessons learned over the past few years.
Charting the course forward, strategic opportunities.
Okay, so they've weathered the storm, learned some tough lessons, and reset their strategy. Looking forward now, where does the real potential lie? What are Fastly's biggest growth opportunities?
Without a doubt, the biggest opportunity, the cornerstone of their long-term strategy and their key differentiator is edge computing, specifically their compute at edge
The
platform.
one growing at 60%.
That's the one. Remember, this isn't just about caching. This is about running actual customer code, business logic right at the edge. When customers build on compute at edge, it fundamentally changes the relationship.
How so? More sticky.
Incredibly sticky, high switching costs. Fastly stops being just a utility provider and becomes embedded in the core functioning of the customer's application. It's much harder to rip out and replace.
Do we have any examples of the kind of impact this can have?
Yeah, there was a case study mentioned with a company called EdgeMesh, which does web acceleration for e-commerce sites.
Okay.
They reported seeing a 5-fold improvement in time to first byte, basically how quickly the page starts loading, and a related 20% increase in conversion rates for their clients after they implemented Compute at Edge.
Wow, 20% increase in conversions. That's
Definitely.
a serious business impact.
Huge. That's the kind of tangible ROI that gets attention.
Yeah.
And Fastly's choice of WebAssembly, WASM, for this platform is smart too. Being an open standard makes it appealing to developers, avoids vendor lock-in fears, and allows that high-performance, secure code execution right at the edge.
So Compute at Edge is really opportunity number one. What else?
Opportunity number 2 is definitely security. We saw it's already 20% of revenue and growing at 15% year-wide. It's evolved from just an add-on to a primary pillar of their strategy and a key cross-selling motion.
Right, selling security to their existing delivery customers.
Exactly. And having strong security offerings is becoming table stakes in this market anyway. Customers increasingly expect their edge provider to handle security seamlessly.
You mentioned a Forrester study earlier showing a massive ROI for Fastly's security solutions, like 235% over 3 years.
Yeah, that study for a composite organization using Fastly's security suite found really compelling numbers. It wasn't just about blocking attacks, it translated to bottom-line benefits.
Like what?
Like a reported $3.7 million profit increase from improved conversion rates, partly because they were better at filtering out bad bots without blocking real users, and a 30% drop in security incidents, which means lower costs and less risk.
That kind of data must be gold for their sales team.
Absolutely. It lets them move the conversation beyond just technical features and talk about tangible business value and financial impact. It helps justify the investment and drives adoption, especially for those larger enterprise deals, pushing up that average revenue per customer.
Makes sense. Okay, so compute and security are key tech opportunities. What about expanding their reach? New markets.
Yes, international expansion is another big one. Management has been quite explicit that this is a key and still largely untapped growth area for them. They've acknowledged Fastly is relatively underexposed internationally compared to some peers.
So they see room to grow outside the U.S.
Significant room. They're putting resources behind it too, like appointing a new VP specifically for the Asia, Pacific, and Japan APJ region recently in June 2025.
Are there challenges with expanding globally?
Oh, sure. There are operational complexities, different regulatory environments, varying bandwidth costs, which could maybe impact gross margins initially.
Right.
But successfully penetrating high-growth international markets offers a potential multi-year tailwind for their top-line growth. It's crucial for diversification and for maintaining that overall growth rate as the U.S. market matures.
Okay, so compute, security, international,
Yeah.
anything else?
I'd point to their ongoing developer platform strategy and ecosystem building. That developer-first ethos is still core to their DNA,
Keeping the techies happy?
pretty much. Making the platform highly programmable, integrating smoothly with the tools developers already use, CI/CD pipelines, Terraform for infrastructure as code, linking easily with cloud storage like S3 or Google Cloud Storage.
And providing good documentation, examples, starter kits.
All of that. It's about reducing friction and making it easy for developers to build on Fastly. The goal is to create that strategic moat based on developer loyalty.
That bottoms-up adoption model again.
Exactly. Win the hearts and minds of the developers, and they become your internal champions within organizations. It can be a really capital-efficient and effective way to acquire and grow customers, complementing the traditional sales efforts.
Stewardship and value management and valuation.
Let's talk about the people in charge. Leadership is always critical, especially during a turnaround. You mentioned there's been a significant leadership overhaul at Fastly recently.
Yes, quite significant. Kip Compton took over as CEO in June 2025. He had previously joined as Chief Product Officer, so he brings deep tech and product knowledge to the role.
Okay, product guy at the helm.
Right. And then Richard Wong came in as CFO in August 2025, bringing a strong background in financial discipline and operations. It signals a clear shift towards balancing innovation with profitability.
And the new CEO, Kip Compton, has talked about this dual mandate, right? Accelerating growth and driving profitability. How's that playing out in their decisions, especially around capital allocation?
Yeah.
That dual mandate seems to be the guiding principle now. Every decision, especially around spending and investment, appears to be viewed through that lens. Will this drive profitable growth?
So, more scrutiny on spending.
Definitely seems like it. There's a clear emphasis on operational efficiency, on achieving and sustaining that positive free cash flow we talked about. It means being more selective about where they place their bets, ensuring R&D leads to commercial success, managing costs tightly.
And for investors.
For investors, the execution track record of this new team is now probably the single most important qualitative factor to watch. Can they deliver consistently on this dual mandate? That's the key question.
Right, let's talk R&D specifically. Still a big expense item for them, I imagine. Innovation doesn't come cheap in this space.
No, it doesn't. R&D remains a significant investment, reflecting that constant need to innovate just to keep up, let alone get ahead. But the focus under the new leadership seems to be shifting slightly.
How so?
There's a much stronger emphasis now on making sure those R&D dollars translate directly into commercially successful products and features that customers will actually pay for. Less science projects, perhaps, more focused innovation.
So, enhancing the core platform, especially in those growth areas like security and compute.
Exactly. You see recent enhancements focused there as things like adding AI-driven features to their security tools, like the DDoS protection with attack insights, or expanding the capabilities of compute at edge. The strategy is clearly about deepening their competitive moats in the high-value areas where they think they can win and command better pricing.
What about growth through acquisitions, M&A? Has that been part of their strategy?
Their M&A history is really dominated by one major deal: the acquisition of Signal Sciences back in August 2020.
Right, that was a big one. Around $775 million.
Yeah, a transformative deal.
Yeah.
Signal Sciences provided the core technology for FSLY's next-gen WAF and really jump-started their modern security business. It showed they could execute and integrate a major strategic acquisition.
And what about since then, more recently?
Activity's been much more subdued, which aligns with that shift towards capital discipline and focusing on organic growth and profitability. Any recent deals, like acquiring a company called Domain in August 2023, have been much smaller, more like tuck-in acquisitions. Buying specific technology or talent to enhance an existing feature rather than making huge company-altering bets. Future M&A, if it happens, is likely to follow that smaller, targeted model.
Okay. So how would you assess the new management team's communication and execution so far? Early days, but what are the signs?
Communication has been pretty clear and consistent. The messaging around diversification, profitable growth, operational efficiency, it's been hammered home. And we are seeing tangible progress that aligns with that messaging.
Like the improving metrics we discussed.
Exactly. Declining customer concentration, those improving non-GAAP operating margins, hitting positive free cash flow. The early results seem to back up the talk.
But as you said, they are relatively new in these roles. What does that mean for investors trying to gauge the future?
It means that while the early signs are promising, they haven't yet established that crucial long-term track record of consistent execution over many quarters through different market conditions. Their ability to consistently meet or maybe even beat their guidance for growth and profitability going forward will be the real test. It's still very much a show-me story for this leadership team.
Okay, let's get to valuation. How is FSLY priced right now compared to its peers and its own history? You mentioned a discount earlier.
Yeah, it trades at a pretty significant discount. Looking at the trailing 12-month price-to-sales ratio, the TTMPS, it's hovering around 1.90x.
0.9x sales. How does that compare?
That's really a fraction of the premium multiples that are often awarded to competitors like Cloudflare or other high-growth software and infrastructure companies. It's also well below FSLY's own historical valuation, ranges from when it was growing faster.
So the big question then, is this a value trap? Looks cheap for a reason, because the business is fundamentally flawed or the turnaround won't stick? Or is it a genuine value opportunity? The market is just slow to recognize the positive changes and the potential.
That is the absolute crux of the debate for anyone looking at FSLY right now. You can make a solid case either way.
Okay, give us the bull case. Why might it be undervalued?
The bull case argues the market is lagging. It hasn't fully priced in the positive inflection points we've seen, that revenue growth re-accelerating to 12% in Q2, the clear path now to non-GAAP profitability, achieving sustainable positive free cash flow. Bulls would say a PS ratio under 2x is just too low for a company showing these signs of improvement in a large and growing market. They'd argue there's potential for a significant re-rating upwards if management keeps executing.
Okay, makes sense. What about the bear case? Why might the current low valuation be justified?
The bear case says, hold on, the valuation is low for good reasons. That guided 9–10% growth for 2025, while better, might not be exciting enough to warrant a premium multiple in this super competitive industry. Bears worry that the recent profitability improvements might be fragile, or that intense competition from hyperscalers and Cloudflare will ultimately cap Fastly's growth potential and keep margins under pressure long term. They'd argue the risks still outweigh the potential, justifying the discount.
So it really hinges on whether you believe the turnaround is real and sustainable.
Exactly. It comes down to your conviction in this new management team and their ability to navigate those competitive threats while delivering profitable growth.
Given where Fastly is now kind of transitioning from high growth and profitable to maybe moderate growth profitable, what valuation methods make the most sense to use?
You'd want to look at it from a few angles.
Right.
Forward EV to revenue is common for companies at this stage, using projections for future revenue and maybe factoring in target margins.
Yep.
A discounted cash flow, DCF analysis, is much more meaningful now that they're actually generating positive free cash flow. You can build scenarios around future cash generation, which is useful.
Right. DCF gets more relevant with positive FCF.
Definitely. And another interesting one could be some of the parts, SOTP analysis.
How does that work?
You'd try to value the different business segments separately, put a multiple on network services based on its growth, a higher multiple on the faster-growing security segment, and maybe an even higher one on the potential of compute at edge. Then add them up.
To see if there's hidden value being masked by the slower legacy business.
Exactly. It could help highlight the value being created in those higher growth areas that might get lost when you just look at the blended overall company multiple. But ultimately, whatever method you use, the output is going to be heavily influenced by the assumptions you make about their future execution.
Navigating the road ahead risks and key investment considerations.
All right, so we've talked opportunities, financials, management, but a thorough analysis has to include a clear-eyed look at the risks, right? What could go wrong? What could prevent Fastly from achieving its goals?
Absolutely. Let's lay out the key risks investors need to consider.
Okay, first, customer concentration risk is still there. Even though it's improved, the top 10 customers are still 31% of revenue. A significant chunk is usage-based, often without long-term fixed commitments.
Meaning a big customer could still walk or drastically reduce usage, causing a hit.
Exactly, like the TikTok situation showed. Or just a downturn in one of their key customer industries, like media or e-commerce, could have an outsized impact. That industry concentration adds another layer of risk.
Okay, concentration risk. What else?
Technology and operational risk. This is fundamental. Their entire business relies on their platform being performant, reliable, secure, any major outage, security breach, defect.
Could be catastrophic for reputation and customer trust.
Absolutely. Plus, they depend on third-party data centers and network providers, introducing external dependencies. There's the risk of falling behind technologically if they don't innovate fast enough. And even supply chain risks, getting the server components they need from a limited set of suppliers. Lots of operational plates to keep spinning.
Makes sense. Then there's the big one, competition.
Yeah, competitive risk is huge and constant. Those hyperscalers, AWS, Azure, Google with their massive resources, bundling capabilities, aggressive pricing, they are a persistent threat.
Potentially commoditizing the space.
Right. And direct competitors like Cloudflare and Akamai aren't standing still either. Plus, there's always the risk that very large customers decide to just build their own in-house solutions for edge delivery or compute, bypassing Fastly altogether.
Okay, what else is on the risk list?
Execution risk. This is maybe the biggest one right now. The whole bull case rests on this new management team successfully executing a complex turnaround.
Meaning they have to deliver on multiple fronts.
Yes. Sustain that revenue re-acceleration, nail the go-to-market strategy, especially internationally, hit those profitability and free cash flow targets consistently, and keep differentiating their products, particularly compute at edge. A slip-up on any of these could derail the story.
So a lot hinges on this new team's ability to execute flawlessly.
Pretty much. And finally, you still have general market and financial risk. Remember their history of gap losses. The usage-based model introduces inherent revenue volatility tied to economic cycles. A broader downturn impacting IT spending would definitely hit them.
Okay, that's a comprehensive list of risks. So, boiling it all down, for our listener watching Fastly, What are the absolute most critical factors they should focus on to gauge future success?
I narrowed it down to 4 key things. Number one, execution by new management. Watch their consistency, their decision-making, how they allocate capital. It's paramount.
Okay, number 2.
Momentum in high-growth segments. Keep a laser focus on the growth rates for security and especially for other computed edge. Sustained high growth there is vital to offset commoditization elsewhere and drive margin expansion.
Got it. 3rd.
Sustainability of profitability and free cash flow. Hitting these milestones is great, but they need to maintain and ideally expand these metrics consistently. That de-risks the whole financial profile.
And number 4.
Competitive resilience. Look for proof points that Fastly's best-of-breed platform is actually winning deals, especially enterprise deals for computed edge, against those bundled offerings from bigger rivals. That validates their core strategy.
Execution, high growth momentum, profitability, FCF, sustainability, and competitive wins.
Got it.
Yeah.
Are there specific KPIs, key performance indicators, you'd recommend tracking? Definitely. Beyond the headline revenue and earnings, watch these. Segment revenue growth, YoY, particularly for security and other. Keep an eye on that. Last 12-month net retention rate, LTM NRR, needs to stay above 100% and hopefully trend higher. Track enterprise customer additions. Monitor the non-GAAP operating margin and free cash flow margin trends, and look at remaining performance obligations, RPO, for visibility into contracted future revenue.
That's a good dashboard. Now, this whole turnaround sounds like it takes time. What's a reasonable investment time horizon here? And what could be potential catalysts to really change the story or the stock price?
Yeah, this isn't likely a quick flip. You probably need a medium to long-term time horizon, think maybe 18 to 36 months, to really see if this turnaround fully takes hold and gets recognized by the market.
And catalysts, what could really move the needle?
A few things come to mind. Sustained double-digit growth for several quarters in a row would build confidence that the reacceleration is real. Achieving actual GAAP profitability, not just non-GAAP, would be a huge milestone. Landing a truly major compute at edge win, like a well-known flagship enterprise adopting it widely, would be powerful validation. And ultimately, a broader shift in analyst and market sentiment, moving from skepticism to belief in the turnaround story, could lead to significant multiple expansion. Outro.
Ooh, that was certainly a deep dive into Fastly. We've covered a lot of ground unpacking their unique edge cloud platform, how they're moving beyond just CDN.
Yeah, navigating through those pretty significant challenges, the TikTok impact, macro pressures, intense competition.
Right, and highlighting that critical pivot towards those higher growth, potentially higher margin areas like security and compute at edge, all underpinned now by this new management team focused on profitable growth and capital discipline.
It really is a fascinating case study, isn't it? How a company tried to navigate a maturing core market by innovating into adjacent, faster-growing opportunities. And it perfectly illustrates that thin-line investors have to walk between seeing a potential value trap versus a genuine value opportunity, especially during a major transformation like this.
Absolutely. It leaves us and you, our listener, with a final thought to chew on. What really stands out to you about Fastly's story? Given the sheer power of the competition, the tech giants and Fastly's own dual mandate of driving growth while achieving profitability, can a specialized best-of-breed edge platform like Fastly truly carve out and defend its niche? Can they become indispensable?
Or will the edge ultimately just become another feature, swallowed up and bundled within the broader cloud ecosystem?
It's a crucial question, something to keep pondering as this whole edge computing landscape continues to evolve at lightning speed.